understand what is marginal costing. The word marginal refers to something. The word marginal refers to something additional. So the marginal cost is the change in the total cost when the quantity produced is incremented by 1. That is, the cost of producing one more unit of a good is the best example to let you understand what is a marginal cost. Marginal cost, that is the cost of producing one more. Marginal cost is equal to the cost of producing one more unit. The cost of producing one more unit, that is known as marginal costing. Marginal costing is a technique wherein the marginal cost, it is also known as variable cost, is charged to units of cost, while fixed cost, it is the cost that is for period completely written off contribution. Contribution in all you will learn further, but as an introduction, marginal cost, it is the variable cost that is changed to the units of cost. For example, if 10 apples cost you 100 rupees, then 11 apples cost you 110 rupees. Here, that is variable cost is units of cost. If it is for 10 apples, if it is 100 rupees, then one apple is 10 rupees. So therefore, then the cost should be 110. This is marginal cost. Let us discuss this with a small example. Let us discuss what is marginal cost with one small example. So say if the variable cost per unit is rupees 25, the variable cost per unit is equal to 25. Fixed cost is equal to 1 lakh. So variable cost per unit is equal to 25 rupees, fixed cost equal to 1 lakh rupees. Therefore, the cost of, for example, say 10,000 units, the cost of 10,000 units is equal to, the cost of 10,000 units is equal to 25, that is 25 rupees per unit into 10,000. This 10,000 is number of units. Therefore, the cost of 10,000 units is equal to 2 lakhs, 2 lakh 50,000. The cost of 10,000 units is equal to 2 lakh 50,000. If, for example, now the company, see, keeping all this aside, now if the production wants to be increased with the 10,000 and 1 units, 10,000 and 1 units, that the total cost is equal to, the variable cost is equal to 2 lakh 50,000 25 rupees. 2,50,025 rupees. Now see, now you have the following information. Variable cost per unit is equal to 25. Fixed cost equal to 1 lakh. So the total cost of 10th, or the cost of 10,000 units is equal to 10,000 into 25, that equal to 2,50,000. Here this cost of 10,000 units is variable cost. Therefore, total cost equal to variable cost plus fixed cost. Here it is 2,50,000 plus 1 lakh is equal to 3,50,000. This 3,50,000 is the total case. Okay. Now in case 1 you have the total cost is, in case 1 you have the total cost of 3,50,000. Now at the rate of 10,000 units. Now imagine if the company wants to produce 10,001 unit. If the company wants to produce 10,001 units. So this 10,001 units. So again the total of the total cost is equal to variable cost plus fixed cost. Here variable is 25 into 10,001, that is 2,50,025 rupees, plus fixed cost 1 lakh equal to 3,50,025 rupees. So here the marginal cost is, here 3,50,000, here it is 3,50,025. So that particular marginal cost in the above example is 25 rupees. This is marginal costing. What is the need for marginal costing? What is the need for marginal costing? Let us see why the marginal costing is required. Marginal costing is required because the variable cost per unit remains constant. So the total fixed cost remains unchanged. Fixed expenses exclude from total cost. So the need for marginal costing will be explained by knowing its features or say characteristics. By knowing its features or say characteristics. Characteristics of marginal costing. The characteristics of marginal costing. Classification of cost is one classification, one characteristic. Is the another characteristic. Property is another characteristic. Determination of prices, another characteristic. Classification into variable cost and fixed costs. Costs are bifurcated on the basis of variability into fixed costs and variable costs, and also in the same way semi variable cost is also separated. The next feature is valuation of stock. While valuing the finished valuation of valuing the finished goods and work in progress, only costs are taken into account. However, the variable selling and distribution overheads are not included in the valuation of inventory. And the next one is determination of price. The prices are being determined on the basis of marginal cost and marginal contribution. Profitability. What is profitability? The ascertainment of departmental and products profitability is based on the contribution margin. Marginal costing is used to know the impact of variable cost on the volume of production or output. The break-even analysis is an integral and important part of marginal costing. So marginal costing is used to know the impact of variable cost on production or output. The first one here is impact of variable cost on output. Marginal costing is used to know the impact of variable cost on the volume of production or output. The next one is break even, and the next one is break even analysis. It is an integral and important part of marginal costing. And the next one, contribution of each product or department is the foundation to know profitability of the product. And the next one is contribution. Addition of variable cost and profit to contribution is equal to addition of variable cost to and profit to contribution is equal to selling price. Addition of variable cost and contribution is equal to selling price. Addition of marginal costing to profit is equal to selling price. Generally, you see selling price is equal to cost price plus profit. Here marginal cost is manufacturing one particular that extra product is known as marginal costing. Therefore, marginal costing refers to selling price. It is the base of valuation of stock of finished product and work in progress. Fixed cost is recovered from contribution and variable cost is charged to production. One of the other feature is fixed cost is recovered from contribution. Fixed cost is recovered from contribution. And the variable costs are charged to productions. Variable costs are charged to production. The costs are classified on the basis of fixed and variable costs only. Semi-fixed prices are also converted either into fixed cost or variable costs. Various terms used in marginal costing. Marginal costing equal to sales fixed cost plus profit equal to sales minus variable cost. Contribution. Here the contribution, it is the difference between sales and variable cost or marginal cost of the sales. It may also be defined as the excess of selling price over variable costs per unit. Profit volume ratio, you also known it as PV ratio. It is the ratio of contribution to sales which indicates the contribution earned with respect to 1 rupee of sales. It also measures the rate of change of profit due to the change in volume of sales. Here you can observe the formula. P ratio equal to contribution by sales into 100. PV ratio is equal to profit by sales into 100. Break even point. Break even point is a situation of no profit or no loss. When contribution is just enough to cover fixed costs. In terms of quantity, fixed cost by contribution per unit. In terms of amount, fixed cost by PV ratio. These are the formulas. Now let us understand the advantages of marginal costing. Advantages of marginal costing. What are the advantages of marginal costing? It is easy to operate. Advantages. It is easy to operate and simple to understand. Helps in profit planning. Easy to use. Helps in profit planning. useful in useful in decision making different and avoids arbitrary allocation of fixed costs. And then under marginal costing, inventory is done at the inventory valuation is done at the marginal cost, and also the fixed costs are not controllable in short period. It helps to concentrate in control over the variable costs. So these are the advantages of marginal costing. In this marginal costing, you are always hearing two things specifically. One is profit, and the other one is contribution. So, contribution, it includes fixed cost and profit. Contribution, it includes fixed cost plus profit. And marginal costing technique uses the concept of contribution. And break even point, what is break even point, we will be learning further. Right now, at the break even point, that is at the point of no profit, no loss, the contribution is equal to fixed cost. That is, when there is no profit, contribution is equal to fixed. When there is no profit, contribution is equal to fixed cost. Contribution concept is used in decision making. Okay, now coming to profit. Profit does not include any fixed costs. Profit does not include any fixed costs. And also, it is the concept in accounting. It is the concept of accounting to determine profit or loss of a business concern. Only sales in excess of break-even point results in profit. Okay, profit, when profit will be happening? Sales break even sales minus sales. So only that is considered as profit, and this profit is computed to determine the profitability of the product. Here there are some formulas that you will be able to understand in marginal costing. Say for example, if a company has sales, variable cost, say if it is given, say for example, variable cost equal to 2000, so the sales minus variable cost is equal to contribution. So 10,000 minus 2000 is equal to 8,000 is the contribution. From this contribution you have to reduce fixed price, that is fixed cost. Say for example, the fixed cost is like fixed cost, the remaining amount from 8,000 minus 1500, that is 7,500, is known as profit. is known as profit. So the sales minus variable cost is equal to contribution, and the contribution minus fixed cost is equal to profit. So these are the some formulas. Thank you.